Welcome to The Explainer. Today, we're shelving the daily metrics and the short-term noise to conduct a strict on-chain audit of the PLAZM protocol. We're adopting a very dry, forensic approach here to understand exactly what is happening under the hood on day 214. So if you're looking for a hype-filled market recap, this definitely isn't it. But if you want to understand the pure mechanical reality of holder concentration and structural demand floors, well, you're in exactly the right place. Just a quick, absolutely crucial reminder before we get going. This explainer is strictly for educational and informational purposes only. It's not financial advice. PLAZM is an experimental DeFi system, meaning it involves smart contract risks, economic risks, and the very real potential for a total loss of capital. Always conduct your own independent research and never invest more than you can afford to lose. Okay, let's dive into this. Our forensic docket for today covers 6 main areas. 1. The forensic question. 2. The 1% math. 3. The BBB engine teardown. 4. The concentrated bid. 5. 2-cycle forward math. And finally, 6. Protocol failure modes. Part 1. The forensic question. Investigating the sub-30 sentiment anomaly. You know, every good investigation begins with a piece of data that simply doesn't fit the accepted narrative. Just look at this juxtaposition. We have broader market sentiment dropping the fear and greed index to 26. That is deep retail fear. Fresh entries across the entire crypto space were slowing down. But the undeniable on-chain reality for PLAZM? A daily price move of positive 9.36%. Literally a nearly 10% green candle on a day when the crowd was panic thawing. Which leads us directly to our core forensic question. Who exactly is the marginal buyer of PLAZM when retail sentiment is completely down in the dumps at sub-30? The price action loudly declares somebody is buying aggressively. Fortunately for us, we don't have to guess. The blockchain ledger holds the undeniable answer. Let's move to part 2 and see how this builds, the 1% math and the reality of the supply ledger. To really understand who is buying, we first have to look at the mechanical supply constraints. The total theoretical supply is 12.7 million tokens, but right off the bat, 19% of that is permanently burned. It's gone forever. Another 12% is currently staked and locked from sale, and 14% is sitting in liquidity pool positions. Subtract the burned, the staked, and the LP'd tokens, and you are left with a surprisingly tight liquid float of just 55%. That is only 6.99 million sellable tokens. Now, what's really interesting about this is what it means for ownership. 1% of the total supply is 127,000 tokens. At today's price, acquiring 1% of the entire PLAZM supply costs just $1,664. Because the liquid float is so remarkably small, buying that slice gives you a structurally massive footprint in the active market. Concentration here is highly accessible to anyone treating this as a serious, committed position. All right, on to part 3. The BBB engine teardown, where we dissect the structural demand floor. So we've established that the supply is tight, and concentrated holders are utilizing a margin strategy. And to be absolutely clear, that's a committed margin strategy, not leverage, to accumulate. But there's another buyer in the room. The BB pools are the mechanical heart of this demand floor. This is an automated, non-discretionary engine. It doesn't check Twitter. It simply takes the real yield generated by the protocol's bond complex and continuously executes 3 specific functions: buy and burn, buy and build, and buy and grow. This is a mechanical reality, guys, not some marketing claim. Let's methodically read through the receipts. First, buy and burn routes 65% of all yield to purchase and permanently destroy tokens. Its lifetime contribution is 79,460 USDC. Notice I said contribution, not fee. Next, buy and build takes 10% of the yield to deepen market liquidity. Its lifetime contribution sits at 29,580 USDC. Finally, the leg no one really talks about, buy and grow. Using roughly 20% of the yield, it doesn't buy tokens, it buys more bonds. Right now, it's compounding 1.6 net new bonds every single day, requiring 0 outside capital. And I should definitely note, cumulative claimed profits for the protocol already sit at over $130,000, proving this engine has been consistently deploying capital. And as we speak, there is $1,660 in current buy pool reserves just sitting there waiting to be mechanically deployed in the next cycle. This capital fires every 24 hours, regardless of market sentiment. Combinatorially, burn shrinks supply, build deepens liquidity, and grow expands future yield. It is a constant, unfeeling floor. Which brings us to part 4, the concentrated bid, synthesizing that 9.36% move. We now have to reconcile the engine's continuous mechanical flow with the outsized daily price action. And here is the analytical punchline. The implied daily contribution from the buy and burn engine right now is about $186. On a market cap of around $166,000, that should grind the price up maybe 0.1%. But the price moved 9.36%. That move is literally 50 times larger than the engine's mechanical 24-hour contribution. So, the crucial point is this. The engine provides the continuous floor, but the aggressive upward spike tells us that concentrated holders, these are wallets that recognize the tight liquid float and the structural value of the bond complex, stepped in. They deployed their own capital, hitting the bid right alongside the automated engine on a day when retail sentiment was sub-30. This is exactly what it looks like when structural supply scarcity meets non-retail demand. Let's shift to part 5. 2-cycle forward math projecting the real yield floor. What happens if we project this exact mechanical reality forward over the next 2 staking cycles, which is roughly 154 days? Well, this brilliantly illustrates the sheer disproportionate scale of the mechanics. At current rates, the bond complex is generating an annualized real yield of $104,500 USDC. Across the next 154 days, that translates to roughly $44,100 of structural buy pressure. Against a current market cap of only $166,790, that means more than a quarter of the market cap will be mechanically pushed through the buy, burn, and build channels. And that's before even accounting for the compounding effect of buy and grow, or independent non-retail buys. Finally, part 6, protocol failure modes, or where this whole thesis could break. A true forensic analysis requires an honest, dry assessment of the system's vulnerabilities. There are 3 primary systemic risks here. First, a severe Vault ETH drawdown. If Ethereum crashes by 50%, the Vault's USD value halves, the bond APR mathematically halves, and the BBB engine slows down. Second, a sustained APR compression, shrinking the future yield base. And third, a smart contract exploit. Look, this is experimental DeFi. An exploit would be terminal. At a 22% APR today, the first 2 aren't exactly flashing red, but smart contract risk is an ever-present reality that dictates position sizing. Which brings us to our final forensic verdict for day 214. We set out to find the marginal buyer on a fearful day, and the receipts give us the answer. The BBB pools are the mechanical floor, concentrated holders are the aggressive bid, and the fear and greed index? That is just noise. The protocol is currently growing its yields base, shrinking its supply, and deepening its liquidity without needing a single new retail wallet to enter. But I will leave you with this to consider. With a liquid float of just 6.99 million tokens that is tightening every single day, what exactly happens to this architecture when retail fear finally turns back to greed? And finally, one last uncompromising reminder. This explainer is for educational purposes only and is not financial advice. Decentralized finance carries severe risks, including the total loss of your capital. Always do your own research, and we will see you next time for another deep dive into the ledger.